Welcome to a new episode of the Industrial Insider. I'm Jonathan Gornstein. My guest today is Carl Gomez, Chief Economist and Head Market Analytics at CoStar. Welcome to the podcast, Carl.
Hey, Jonathan, how are you?
Good, thank you. And yourself?
Good, thanks. Doing well.
Carl, you and I met when you were giving an online presentation of the long, winded road to the new normal. So we're getting close to the new normal. Especially in commercial real estate. So why don't we walk through a few things of the whole economy, the industrial world, the office world, and we'll just have essentially a fireside chat of what's going on. So I guess my first question, in terms of inflation, that's the big buzzword these days. What is your take on inflation and where are we going? Anything you could, I guess, shed some light on the inflation topic.
Sure. You got it right there. I mean, it is the biggest word out there. It's in cocktail parties. You go to the grocery store, everybody's talking inflation. As an economist, it's kind of interesting because it used to be one of my favorite topics, but nobody wanted to talk about it. I guess the reality is it's affecting everybody. We're seeing the strongest price growth in 30 odd years. Inflation is well above the Bank of Canada's target range of 1 to 3%. And I think it's surprised everybody, including central banks. You know, you think about the pandemic, everybody said, well, this is just going to be transitory. We're coming out of it. And then all of a sudden it continued to stick.
Right.
And so it's surprising everybody. But the reality is, you know, when you think about it, there are two factors that always cause prices to go up: strong surging demand and limited supply. And you've got a perfect storm of that right now. Demand is surging coming out of a pandemic. There's a lot of pent up demand. A lot of people were fueled with a lot of extra stimulus, right? And you think about low interest rates, you know, all the pumping that the fiscal governments did. At the same time, though, after the pandemic, a lot of the supply chains have been disrupted. Supply hasn't been able to get to its shelves. We've got a war in the Ukraine, which is limiting energy stuff. China is still effectively in lockdown, and they're the manufacturing capital of the world. Right. So that's kind of the view of why inflation is sticking around. And I think, you know, for central banks, you know, the Bank of Canada, the Federal Reserve, a lot of them were caught off guard by this. They didn't think that was going to be the case. And now they're playing a game of catch up because their only job was to manage inflation and keep inflation at 1 to 3%. Right. Suddenly they're not there anymore. So there's a credibility game these central banks are playing right now to get inflation down.
We all know that you're constantly looking at numbers and analyzing data. Can you give us some type of key indicators that you're looking for to get a read on the market and how we should proceed forward? Are there any key things that we should be aware of and that you're constantly looking at?
Yeah, a great question. You know, as economists, we always try to look at GDP. And, you know, I'll say as an economist right now, I am not looking at GDP. GDP is a lagging indicator of growth. We won't know where we're going when we get data on that. It'll just tell you where you've been. It's a rear view sort of look. I'm looking at some leading indicators that kind of look at where consumers are, because I think consumers may be the ones that lead us down and towards a recession. Two things that we're looking at right now is real wage growth. Are people's wages keeping up with inflation? And they're not. They're still declining. So consumers are losing purchasing power very quickly at a time when they still are exercising their pent-up demand. The other indicator is looking at what's happening directly to interest rates, right? We've gone from effectively zero to up to somewhere which is actually contractionary for the economy. And given that consumers are dealing with a very high mountain of debt, that people are facing, you know, tighter budgets. You got more inflation, rising prices, higher interest rates. That is a major concern. So we're looking at that very closely because I think those indicators are going to dictate what the Bank of Canada ultimately does, whether they're going to stop raising interest rates or even pivot to dropping rates.
Right.
But it also sets a precedent, you know, for commercial real estate as well. You know, we've been in a 30-year cycle of seeing cap rates compress along with interest rates, and now all of a sudden that spread for real estate between a cap rate and interest rates is razor thin. Right. Does that mean values have to change in commercial real estate going forward or not? It really hangs on what happens with those rates. So as an economist, that's what we're looking at and what's driving this situation right now.
Well, what's your take on real estate values on the industrial side? What do you think?
Well, you know, it's interesting, right? If we talk about the GTA and industrial cap rates, there have been deals now more recently that have been below 4% caps.
Yes.
Very, very aggressive pricing on industrial. My view is that it's for good reason. The fundamentals are absolutely sound. You've got very strong demand for industrial warehouses and limited supply. Like we talk about the limited supply on the housing side, it's very difficult to get new industrial buildings put up, right? I mean, they're long lead times. We've got green belts, all of that sort of stuff. So fundamentally, with that supply and demand picture, we are now seeing substantial rent growth in the industrial market. Vacancy rates are sub 1% in the GTA.
Yep.
Industrial rents are growing, anywhere from 20 to 25% a year over year, well above inflation. In my mind, if you're an owner of industrial or if you're buying industrial, your cash flows can grow very strongly.
Right.
That to me justifies to some extent the low cap rates that are there. There is a come to Jesus moment where the spread between industrial and cap rates are so thin that you're not being compensated for it. And, there's some logic in saying, well, cap rates need to adjust because of interest rates.
Right.
I always say this, interest rates are a fixed income investment. That cash flow never changes.
Right.
Real estate's not. And you can grow that thing or you can redevelop and create more value. So that's why I personally believe cap rates can stay there, assuming, of course, that interest rates don't continue to shoot up, which I don't personally believe. And so I think there's good, strong fundamental value behind industrial, even at a 4% cap.
I guess another big buzzword is fundamentals. We constantly keep hearing the fundamentals are strong in industrial real estate. Are there any other key indicators that you believe that show that the industrial market is strong compared to like the office or retail market?
I guess the major comparison is just looking at availability or vacancy rates. Right now, as I mentioned in the GTA, but it's not even just in the popular West GTA or the North GTA. You can even go to the East GTA. You can go even outside of the GTA to places like Guelph and Hamilton,
right,
and you're seeing vacancy rates, sub 1%. The demand is just outstripping supply there. If you compare that to office is on a trajectory to double digit. In many markets, they're already in double digit vacancy right now.
Right.
You've got the complete opposite situation where you have negative absorption in office and a heck of a lot of supply that's coming on in some dark downtown markets.
For sure.
So I think that's the case. I mean, industrial shines just because of those fundamentals. And the other big one, of course, is just when you look at rent growth. Like net rent growth in industrial is outpacing every other single asset class by a very wide margin.
Right.
And more importantly, even though inflation is running at a 30-year high, it's completely outpacing inflation too.
Right. So, exactly. I want to maybe talk about a little bit more about your opinion about rental growth. Rental growth over the last, let's say, 48 months has been on this tear year over year. Do you think we can sustain that type of rental growth going forward? Or do you think just given the data, given interest rates, everything else that you just said, do you think we're going to be somewhat flat going forward? Or do you think we'll quote unquote normalize to a more normal growth year over year?
Well, it's a great question. And, here at CoStar, we get asked that by clients a lot, like how long is this runway for industrial rent growth? My story lends itself to the whole idea of just-in-time inventory. This was a fundamental change in the way goods are distributed, brought out, whether we're talking logistics, e-commerce, retailers, everybody's moved to just-in-time inventory. It's a way of satisfying the consumer by reducing the supply chain costs along the board. And an integral part of this just-in-time inventory story is industrial warehouses and industrial space. Right. It plays a key role in being able to facilitate the transfer of goods from the manufacturer back to the consumer.
Right.
I'll give you a little bit of a story. Dialing back about 10 years ago, I used to work for a very large asset manager, real estate asset manager. And there were some grizzled guys who worked in the industrial side. They've been long, worked 20, 30 years in industrial. And I went to them in a boardroom one day and said, look, our research is saying just-in-time inventory is going to cause a substantial spike in demand.
Right.
And GTA industrial rents were $5. They'd been $5 forever.
Right.
And I said, look, they're going to move to $8. We're going to see some increase. And the funny thing about these guys is they all turned to me and said, look, you're a young guy. You have no idea what you're talking about. Nobody pays more than $5 in the GTA for industrial space.
Right.
Guess what? We got to $8. went back to the same room about 5 years ago and said, look, it's going to go to $10.
No, you're crazy.
They called me crazy again, and sure enough, we got there very quickly. My story here is one where we're at 15 and change right now. Everybody's saying there's no way people are going to pay up. They are going to pay up. And here's the reason why. When you think about transportation costs, they range at about, I guess, 50 to 70% of total logistics cost for most of these guys.
Right.
When you think about real estate only ranges from about 2 to 6%.
Right.
These are what's far more important to these guys is time to market. They need to get this stuff done. And, especially during the pandemic, we went from just in time inventory to just in case inventory. Gosh, we can't get the stuff done. We need these. That's why demand surged during that period of time.
Right.
Basically, what I'm saying here is the runway is steep because the time to market is a more important cost, and people are just going to be willing to pay whatever they can to get the best properties. The other way to think about it is the number one player who sets the market these days is a company called Amazon, and they have a very big balance sheet. I don't know if you've heard of them or not, but they come in and they can pay whatever they want. They set the market price, and that's pushing the market up as well. So my personal view, and it is very much a personal view, but I think a lot of people who are looking at the market closely are seeing this based on the fundamentals, is that the runway is pretty steep for industrial rents.
So in terms of the quantitative number to make it just in time, do you think there's a number there that it does make sense and it doesn't make sense, or you don't think we're at that point?
I don't think we're at that point. I look internationally. There's a big deal that went on in Canada here with Dream and Summit.
Yeah.
And, one of the comments that everybody said is like, when they look at the industrial real estate that was in Canada, on a US dollar basis, our rents are still very low. They're not even that high compared to, if you put everything on a level playing field, there's lots of runway there compared to what we're seeing in other markets. Right. Another way to think of it is in a place like Tokyo, which is very constrained. Right. And, with land and difficult, but you've got lots of demand. It's a very populous sort of place. Rents are above $20, way above $20.
Right.
I think we're already seeing that to some extent in Vancouver.
Yeah.
Vancouver's industrial market's a little different than the GTA. It's a little bit more of an end user sort of market. But the point being is that there are folks out there that will pay for this stuff and get up to that level. So
right. Do you have any other or you know what? I know this is an industrial podcast and there's been a lot of talk about getting back to the office and whatnot. Why don't we just touch on that for our last piece, just to round off commercial real estate as a whole? What are your thoughts about the hybrid model or anything else that relates to office? Like, what are you seeing and what do you think the trends are going forward?
It's interesting because I was very bullish and painted a very great story for industrial. If I was to be, unbiased and completely candid with you, I think the runway for office is a lot more of a pessimistic story.
Yeah.
One of the things that came out of this pandemic was obviously the ability for companies to have their workers work from home and still be productive. And that productive point is a key point. Productive not only for the output of the companies, but also productive for people who were able to, you and I both have kids. We're busy people. We were just talking about, being able to get to parties and take them to these places. The world's changed from when we were kids, and we're busy workers, but we also value our job. Being able to work part-time from home gives you a lot of opportunity to be more productive with that. Right. And I think what's happening with a lot of tenants, big tenants especially, is they recognize that to retain talent, to keep the employees engaged, they have to offer some sort of hybrid sort of situation. But what does that mean for real estate? Well, it means for real estate that a lot of tenants are reassessing how much space they actually need. Right. That means that we are seeing, and I look at job numbers, office employment growth, and we've seen some very strong office job growth through the pandemic. Right. Historically, that would relate to positive net absorption for office. That makes sense, right? More people, you need more bums in the seat, you need them there. That hasn't happened. It's actually come apart. And that really tells me that the tenants, along with the rise in sublease space, are completely reassessing their space needs. So, the takeaway from that is that office is going through, what maybe retail was going through 10 years ago as a result of e-commerce. Fundamental big changes in the way we live and work is changing the need or demand for office. My personal take, again, is that I don't think downtowns are dead. I don't think offices go away, but the demand is going to be more so for those office buildings that are flexible in their floor plan, have best technology, accommodates this kind of interchange of hybrid work. And that means that older office buildings that are less flexible, maybe not as accommodating to this new world, will need to be either redeveloped or changed in its use. And that's a big change.
I know you're busy, and I have one more point that we want to hit on. Industrial development. I know it is a big talk of how much product is coming on the market. What is your take on how much product's coming on the market? Can we deliver more than what we're delivering? Can we normalize our market by getting more product on the market? Like, what is your take on industrial development going forward?
Well, if we talk specifically the GTA, but we even talk maybe Vancouver as well, the difficulty in Canada with building new industrial, we're not like the Inland Empire or Texas or something like that. You just don't go to a municipality to give me a permit and away I go. I got, I can convert this into 5-year product. It's very onerous to get new supply done. It takes a lot of time to, deal with municipalities to get those permits. There's environmental, there's a cost to it. So, 5-year land turns into 20-year land at the end of the day. It takes a long time to get there. We are seeing a bit of an increase, as we should, in terms of supply coming onto the market, because there's just nothing to lease right now.
Right.
One of the things that we see, though, is as soon as there's a lot of spec development. As soon as this is developed, though, the developer's already got a lead tenant already in mind. Right. So that space is already spoken for by the time it comes to market. I think we're going to continue to see long-term an issue with being able to build enough supply. Vancouver's a poster child for that. There's been a lot of, we talk a lot about the residential market and how we need more housing. Well, municipalities are going to push along that line much more so, and they're going to crowd out the ability to get new commercial space done. Right. And Vancouver is a case in point of that. Residential development is crowded out commercial development, and so that new development has actually started to push through the Fraser Valley and hopped over to Calgary. Right. Where Calgary, it's easy to build stuff. And so Calgary's now become the distribution capital for Western Canada. I see the same thing happening with the GTA. We're going to start seeing new distribution markets, new places where people can build. Hamilton's on the radar with some developers. Guelph has already kind of emerged. The Kitchener-Waterloo triangle is there. They have, transportation networks along the 401 that can still service. There's a good population base for labor. So I think that's where the supply is ultimately going to end up. The other story here is, touching on where rents actually go. Yeah. I think if we do get to the point where rents are in the double-digit levels, kind of like in Tokyo, kind of like in parts of the Western United States, we are also going to see an increasing trend towards multi-story. Industrial, and the economics of development of that will make sense. We've already seen some of that happen now already in Western Canada. There was a specialized thing that happened in Ottawa with that, but I think that may be in our future as well.
Okay, Carl. Well, first off, I wanted to say thank you for your insight. I'm sure a lot of people are going to enjoy the stats and your take on everything as a whole. So thank you for joining me on the Industrial Insider. You can reach out to me at 416-471-0904.